Hey there, I hope you're doing good. First of all, Happy New Year. For me, just came back from a holiday in UK and Paris, and that has been very refreshing for me and my family. So now that I'm back in the new year, it's time to get going with the New Year's resolution. My New Year's resolution is pretty simple this year, and that's called minimization or consolidation. What it means to me from a financial perspective is that I've taken a look at all of my investments and I boiled it down into how I can minimize and consolidate my investment brokerages. Now, I've always been an avid fan of passive investing, which in a nutshell is simply an investment of your monies into broad-based ETFs, a combination of equity ETFs and also bond ETFs. If you don't know what I'm saying, I would like to recommend a book to you, which is called A Boggles Head Investing, created by the person who created Vanguard. So I'll leave a link in the description below if you are interested to check that book out. But in a nutshell, that book simply proposes that you would do much better if you just do dollar cost averaging, investing into broad-based ETFs on a regular basis, be it weekly, bi-weekly, or a monthly basis, and then just let the investment mature or increase. Over time, in a lifespan of about 15, 20, 25 to 30 years, over time, I think that portfolio would be worth more than just keeping cash in your bank. Now, a lot of people out there, they tend to want to do a lot of active-based investing, meaning they buy a hype stock. They buy into something that is trending at the moment, be it cryptocurrencies, be it, let's say, AI, or be it, let's say, health sector and whatnot. And then they would sell it when there is a downtrend in that particular sector. Now, people have made a lot of money buying into good stocks in times are good, and then selling them just before times are bad. Well and good, but I think not everybody is able to time the market well, like Warren Buffett. So if you are too busy or don't understand how to handle investments, my recommendation is really to check out that book and then maybe get started into passive investing. So passive investing to me is just buying into your country-based index fund, and then buying into a world index fund, and then buying into your country-based bond fund. Now, I've been doing this for the past 10-15 years, and the returns that I've been getting has been quite alright. So if I were to take a look at my investments into the Singapore Index Fund, World Index Fund, and also the Singapore Bond Fund, I've been getting around 50% returns over the past 10 years. Not very good, but I suppose it's better than leaving cash in the bank. And I wanted to leave you with another important message that I have about simplification is that I've also used Robo investing to do my passive investment. I've used Stashaway, I've used Endowus, and I've used Auto Wealth. And they're all pretty similar in nature, where you will need to, update your risk profile in these platforms, and then it will give you recommendations into what kind of portfolio that you should invest in. So people with higher risk appetite would invest in portfolios that would invest heavily into equities or stocks, and people with very low risk tolerance will probably be better off investing in ETFs that are more heavily skewed towards bond funds, where the returns are lower, but they're definitely less volatile. Now, for this new year, what I've done is that I have taken a look at the performance of my do-it-yourself passive investment versus a robo investment. Now, the findings I have is that the do-it-yourself investment has yielded me 50% returns over the last 10 years, and the robo investment has only given me about 40% returns for the past 10 years. And that's because the platform that you use for your robo investment usually charges you a platform fee or a service fee for doing the purchases and also the selling of the units. So these fees over time will erode into your gains. So over time, that erosion will take away that gains, and for me, it translated into a 10% difference between a do-it-yourself portfolio versus a robo platform, robo managed funds. Now, what do I mean by do-it-yourself portfolio? Do-it-yourself portfolio just means buying into those funds. For me, it is the Singapore Index Fund, the Singapore Bond Fund, and the World Fund from a platform. I use interactive brokers to purchase all of these funds. I use interactive brokers to, on a monthly basis, periodically, dollar cost average, purchases into the index fund of Singapore market, bond fund of the Singapore market, and also the index fund of the world market. So for Singapore market, I invest in ES3 stock ticker. For the bond fund, it is A35 stock ticker. And for the world fund, I invest in the VWRA fund. That's the Vanguard World ETF Fund. And based on the Bogglehead investing book, I think it proposes some form of a ratio of how much to put into your country-based ETF or the world ETF or the bond ETF. For me, based on my age, based on my risk profile, my bond ETFs is about 40% of my portfolio. 60% of the portfolio goes into Singapore Index Fund and also the World Index Fund. Right. So for this new year, simplification, consolidation, I have now initiated the closure of all my robo investment platforms, and I'm going to transfer the investments into a do-it-yourself portfolio because based on my findings, a do-it-yourself portfolio is much cheaper in terms of fees, and over the long run is going to yield me better results anyways. So I hope that video has been helpful. Please do check out the links of the products, of the books, and also the investment platforms. Yeah, if you're interested to know more, please do leave me a message, and also hit the subscribe button if you like this type of content. Till then, take care and God bless.